Okay, got to have some hand somewhere. Right here. Joe Kennedy. Get the mic. And go ahead and introduce yourself and say where you're from.
Thanks. Joe Kennedy, Pew Charitable Trusts. And I guess my question is, to what extent do you think the current difficulties are fundamentally caused by significant economic imbalances, say, between consumption and savings, between exports and imports, and between the federal government's willingness to spend and its willingness to tax, that we seem to be unable to deal with? And following up on that, can we have a sustainable recovery until we deal with those fundamental imbalances? Thanks.
Each of you can give your view. Mike, why don't you start off?
No and yes.
Would you care to elaborate?
Well, I mean, in terms of the impact of the imbalances, many of these imbalances have been existing for a considerable period of time, and it didn't create steep recessions before. And I don't think it's necessary to get rid of all of them in order to have a recovery. We do have some very important long-run problems for the U.S. economy and society, and the President has spoken about them. We face a major fiscal challenge and I think societal challenge in dealing with the health care issue, which I think is going to be far more difficult to resolve than the present recession. And I could go on that score. Undoubtedly, we had an unsustainable buildup in residential investment, which has happened before, and in house prices, which is more uncommon in recent history of the United States. And the unwinding of that situation is playing a major role in the recession. But I think that problem is actually being corrected very rapidly. The Case-Shiller index of home prices is now back down to where it was in 2003. We're down nearly 30% from the peak, and we're still falling 1.5% per month. So I think we're going to get house prices down to reasonable levels at which we can have a recovery in the housing market by sometime this year, probably around the middle of the year. In contrast, it took Japan 12 years to grind down its real estate prices to reasonable levels. That adjustment is happening very rapidly. It's painful, but it's necessary. And once we've achieved it, then the prospects, I think, for a substantial recovery in home building, which is down 75% from the peak and probably 60% below the sustainable level determined by new household formation and removal of existing homes from the stock, can begin. And it's a long way to come back. Similarly, I think on the trade side, one of the things which sheltered us from a recession for about a year and a half was that as the housing industry shrunk, our real trade balance improved. So we had sort of offsetting corrections of those imbalances. Now I think we'll probably regenerate some of the imbalance on the trade deficit side because we will have a more powerful and earlier recovery than some of our trading partners. That will be a problem down the road for us and for them. But I think in getting the world economy back up and running at a more sustainable pace, having the U.S. lead is not such a bad thing. So I don't believe that it's the imbalances that were the principal source of difficulty. Now, what Simon talked about in terms of excessive risk-taking and inappropriate asset and liability creation in the financial sector and the unwinding of that clearly has been an important part of the story of this downturn. What I insist is that has happened many times around the world and in the United States, and we could go through the history of them. I simply point out that 50 years ago, when I was a high school student, and before I knew anything about economics, I wrote a term paper on a subject I was interested in, which was Andrew Jackson, Nicholas Biddle, and the controversy over the rechartering of the Second Bank of the United States. It's very interesting to study these many episodes in U.S. Economic history in which there have been big financial bubbles, and their subsequent collapse has played an important role in the economic recessions of those times. But the recessions have not lasted forever.
Simon?
Well, nothing lasts forever. I think that's what Voltaire said about the Roman Empire. And of course, no recession, no collapse lasts forever. But if we agree that, I absolutely agree with everything Mike said, including the point that we should think of the dynamics of the situation as being more 19th century, more about massive, prolonged financial and other related but finance-driven bubbles collapsing. So in that sense, you can have your own version of how that bubble's created. I don't mind that. You can tell that story of some imbalance playing a role there. To me, though, the key driver is the way that feeds into the profits of the financial sector, feeds back into their political influence, allows them to shape the playing field to create more profits. And over 30 years, it's a 30-year bubble boom that became a bubble, if you like, that we have to undo, rather than any of the conventional macroeconomic imbalances. Perhaps we argue some of those are symptoms. We might argue some of those are relatively minor contributing factors. But it's the growth of the economic power and the political power of the financial sector that creates a structural issue. And I think your question the spirit of your question is there a deeper structural problem here? Or is there just sort of transitory short-run stuff that we get out of? There's a deeper structural problem. And even if we recover, by the way, even if we get the V-shape, I'm still going to insist that we think really hard about the political economy of banking, because if you started this with, say, 10 or 12 major financial players and you end up with 3, those 3 have an even more compelling put option than before. They have down the road, I'm not saying they do it right away, but down the road, it's even easier or more tempting for them to take on massive amounts of risk that threaten the system. And I would suggest that the contrast between the United States and Europe is that we may well have financial institutions that are too big to fail. I think in some European countries, for example, I think about the UK, the Royal Bank of Scotland. Think about the size of bank assets and liabilities relative to UK GDP. It's an order of magnitude bigger than in the United States. I think in Europe they have banks that are too big to rescue. We have too big to fail. They have too big to rescue.
I would just add one word on the international dimension of the imbalances that Joe asked about, citing none other than Chairman Volcker, who has talked about this quite eloquently. It's quite true that the Chinese and the oil exporters and others who were pumping huge amounts of foreign lending into the U.S. economy did not force us to make stupid subprime loans. On the other hand, that big infusion of foreign capital certainly eased monetary conditions, pushed interest rates down, and helped create the environment within which it was much easier to make the financial mistakes that were made here, and indeed, one might even say, created some of the incentives to make those mistakes. And so as one looks to the next round and trying to avoid repetition of the problem, I would add to the list for policy initiatives trying to limit the big international imbalances of the type we have seen in the past. I think that's particularly important because of one other feature of the crisis that neither Mike nor Simon referred to here, though they have many other times. When you look to previous crises over the last decade or 2 or 3 decades, the countries that fell into them were often able to export their way out of the crisis because the rest of the world was doing okay. Simon did mention, I think, that was true for Japan through the 1990s. It was true for the Asians as a whole coming out of the Asian crisis a decade ago. They were able to export to the rest of the world. You did not have to rely on Mars. This time, the countries that might try competitive undervaluations or efforts to get out through exploiting foreign demand rather than domestic demand might only have one place to look, and that's the United States. If the United States were both able and willing to move back into very large, perhaps even larger, external deficit than before, that would reconcile the desire of a number of other countries, including the Europeans, incidentally, to exploit foreign demand rather than domestic demand, rather than generating the domestic demand that's needed to come out of a truly global crisis. And I think as we forecast recovery scenarios and try to design policies to make them successful and sustainable, that element's got to be factored in. Okay. Yeah, you're it.
Dadush with the Carnegie Endowment. This is a very important discussion because if you believe Mike, we don't have to do much more. It's going to happen. If you believe Simon, we've got a big policy deficit. I want to ask Mike why in his presentation, taking us through the various recessions, he stops in 1945 and why he doesn't go back further. To the Great Depression. The reason I'm asking is yesterday Barry Eichengreen published a paper on a website called Vox EU that shows that the decline in global industrial production and in trade over the last year is greater than the first year that followed the crash of 1929. And the question really is, you're assuming that somehow the mechanisms are there for the recovery to happen. And that is, to me, the heart of the question, which really separates the two of you, in that the argument is that if the financial system is as severely impaired as many of the estimates suggest, given in particular the incredible housing boom and bust that we've had, and if at the same time world economic activity is declining, so there's no external support, where is actually this recovery going to come from? Not at all clear to me.
Well, of course, I don't go back to the 1930s because U.S. quarterly GDP data starts in 1947. So I don't have a very good basis for drawing the comparisons if I want to use that type of information. But obviously, I've looked at that data, and we have industrial production data and a variety of other indicators that we can use that are more frequent than annual GDP to get an idea of what's happening in these earlier business cycles. I would say going back to the First World War, we go beyond the First World War, then it becomes even more difficult, though you can go back to about the Civil War and still get some useful information, though it is a quite different economy back then. The agricultural sector was much larger, manufacturing was much larger, the service sector was much smaller, and so forth. This is really, I think, more the question that really deals with Simon's point. Well, it's different this time because the nature of the crisis and the shock and the financial system are different from all of the earlier post-war recessions. Well, each recession is different, and the question is there sufficient commonality that we can say something useful? I mean, if there is no commonality, then we can just babble on forever without any constraint, and I don't find that particularly useful. So, GDP is consumption plus investment plus government spending plus exports minus imports. And if GDP is going to rise or going to fall, it's got to somehow come through those things. So I like to have a story that at least adds up in terms of the numbers, and where the numbers behave in a manner that is respectful of the regularities that we've observed in the data going back not only over the post-war period, but considerably longer. And we know in business cycles that consumption of services doesn't move very much. It's durables that is the big action in consumer behavior, and to some extent, non-durables. Investment is a big mover, and it's often inventories, but housing is also very big, and so forth. I mean, those are things I think you need to take account of in talking about the business cycle. So the question is, well, when and under what conditions might we expect that the housing sector, which has suffered an enormous decline, might bottom out and recover? Well, I insist that one needs to take account of the fact that new household formation is about 1.2 million per year, and we remove about 500,000 units from the housing stock each year, which gives us sort of a trend demand of about 1.7 million units. And we're producing new units at about 500,000 a year. So we're well below trend. Now, there are good reasons why, given the shocks, that we are in that situation today. And part of the problem is, of course, housing prices have been falling, and people either are fearful if they buy now that the price will fall out from under them, or they're hopeful that if they wait, the price will fall further. Well, we need to get the price down to a point where we've dissipated some of that, and where there's adequate financing for people of reasonable credit worthiness to be able to buy a new home, move out of their existing home and sell it at a price that they don't think if they buy a new one they aren't going to be able to sell the old one. Well, I think we're actually getting near that point with the enormous decline that we've seen in house prices and the big reduction we've seen in mortgage costs, at least for credit-worthy borrowers. And I note a lot of discussion of the financial sector. The savings and loan industry was a total mess, not only in the early 1980s, but throughout the 1980s. So much of what was the mechanism of housing finance before we went into the 1980s recession was blown away in terms of its solvency. Nevertheless, we had a spectacular recovery in the housing sector in the 1980s. And all those people who were mailing 2x4s to Paul Volcker at the time, well, they stopped mailing them because they needed the 2x4s to build the houses that they started to build as the economy recovered. So, yes, there are reasons why this cycle is going to look different, and already has looked different from earlier ones, but that does not repeal all of the regularities of macroeconomic behavior that we've been able to observe and document over the past 50 to 100 years. And I could go on and on about that, but let me stop the answer to the question.
Mike, I've heard you make a similar point about auto demand that you just made for housing demand. Does your argument, I'm just trying to summarize for the group, does your argument focus heavily on pent-up demand developing over this period of downturn, slack in consumer spending? The saving rate rises to some new level, maybe 5% like it is now, and then levels off there, maybe, and then consumer demand resumes its growth. Is that basically the mechanism you have in mind?
Fundamentally, yes. But I mean, I have the savings rate going up to 7%. So it's not that I think that households aren't going to adjust to what looks like a relatively permanent decline in their wealth. I think the wealth will come back some, but I don't think we're headed back with home prices to where we were in 2006. So I think consumers are going to want to save more because they're getting less of a gain from their wealth from other forms. The question is, how large of an effect should we assume? And I'm assuming we're going to push the savings rate up from roughly 0 to around 7%. And I think that that's a quite sizable adjustment. Now, could it be bigger? Of course, it could be bigger. It could also be smaller.
Okay, next question. Oh, Simon, want to come in? Sure.
Yeah, so I agree for the reasons that Mike Nice articulated. It's not the Great Depression in terms of the size of the decline. Services are a bigger part of the economy. The government's a bigger part of the economy than back then. What I haven't found compelling, and we do track this on a daily basis on our website, is evidence of the recovery. What's driving the recovery? And I guess I'm just less willing to rely on these past patterns applying, because much of what we've seen over the past 6 months in particular has been so far outside what we've observed the last 100 years. Perhaps we can agree if we were taking the last 200 years, there may be something there we could discern from those dynamics, but we don't have the data. I guess George Soros today said he thought the shape of the recession would be an inverted square root sign. I've been drawing those all day, and I think I know what he means. It's just way too complicated for me. I'm calling it an L. Until I understand where this recovery is coming from in the US and globally, we're going down a ways, and we're going to stay. I guess he means you get some sort of bounce off the bottom as people rebuild inventories and so on. But then I think he's expressing similar skepticism about what really drives growth back to the kinds of levels that we hope we'll see, and that official forecasts definitely see. I think the G20 communique I think was predicated on and emphasized the IMF is forecasting a return to rapid growth in the second half of 2010. I just don't see that yet.
Simon, before I go to the next question, Simon, let me push you on one point that you made in your remarks as a provocative point, very important point. You suggested that it was anachronistic that governments were not intervening more in central bank activities.
No, what I said was it's an anachronism that heads of government don't feel comfortable discussing central bank policy at a G20 type meeting. I can assure you heads of government discuss monetary policy all the time, including the governing council of the European Central Bank is comprised of representatives of the governments. They don't like to talk about it in these international forums. Somehow the independent central bank mantra precludes that. But to my mind, what Ben Bernanke is doing with his expansionary monetary policy is actually it will create an infectious expansion, infectious in a good way, for my European colleagues, in the sense that the dollar is going to tend to depreciate. That puts upward pressure on the euro, and I think that will be contagious in a way that the fiscal stimulus is not contagious. Why not discuss that a bit more explicitly at a G20 type forum? Why pretend, or why keep it as a taboo subject is my point.
Okay, next question.
Leah from VOA. The Chinese central governor Zhou Xiaochuan recently proposed a global currency. I am interested in knowing what the panelists' take on that. Is it time for a global currency? Thank you.
I might respond on that since I've got an op-ed appearing on it in the FT on Thursday. I think Governor Zhou and others in China who have made that suggestion recognize it's a very long-term idea and not very practical to think about the SDR or any other asset replacing the dollar in the system anytime soon. And his colleagues have made clear that was an intellectual presentation meant for discussion, not for any early negotiation or serious reform. However, there is a part of Governor Zhou's statement that I think does call for early attention. The very last paragraph of his speech or paper suggested creating at the IMF something that used to be called a substitution account, where countries, central banks, official holders who are anxious about the stability of their dollar holdings could convert into SDRs in a new account at the IMF in a totally off-market way. That would enable countries that wanted to diversify their reserve holdings to do so without having adverse market effects. The U.S. would prefer that because it would avoid a sharp fall of the dollar. The Europeans would much prefer it because it would prefer a sharp appreciation of the euro, which is what the conversions would take place into. The Chinese and others would get their diversification, and the global system would remove one potentially important source of instability. So it's a win-win-win-win proposition, and I think that piece of it could profitably be hived off, addressed separately, and pursued. I think it's encouraging, in fact, that the Chinese have made at least that one proposal for modification of the international monetary system that would be quite positive, at least in my view, in the short to medium run. It could lead to longer run changes as well, but that, I think, is the operational part of it. Okay, Ron.
Yeah, thanks, Fred. Ron Blackwell, AFL-CIO. Obviously, this is a very interesting conversation, Fred. I congratulate you for doing this. It's very helpful. You obviously have different interpretations of the nature of this recession. But I wanted to ask you a policy question. Mike said very clearly that he did not think that cleaning up the blockages in the credit markets were necessary to get a recovery going, that might be a more complicated relationship than is often alleged here. I just would ask each one of you to describe what role you see the credit market problem in the recovery. And Simon, you had mentioned that you noticed but didn't describe the kind of reservations that you have with regard to the proposal for moving the banks forward here under the Treasury's plan. What role does recovering the banks play in the recovery prospects that you see, and how do you evaluate the steps that are being taken by our Treasury and Fed to accomplish that?
Yeah, Simon, why don't you elaborate on your doubts about the Treasury plan?
Okay. Well, first, let me ask the sort of central part of the question, which is what's the role of credit in the recovery? And Mike is, of course, right that in many instances it's the recovery that helps improve the balance sheets of the banks rather than the other way around. It's not always the case, but that is certainly one way to do it. And you can also have some inflation, which is, remember, my Bernanke scenario, in which I'm supportive, is one in which there's more inflation than the Fed, I think, believes in its heart of hearts is likely. And a moderate degree of inflation would also help reduce real indebtedness and depending on exactly how that played out, could be most helpful to the banking system. I think the bank system plays a facilitating role in the recovery, and I think if you have further banking system collapses, if you have further repeated crisis of confidence around the banking system, if you have repeated runs on the government, basically, and I think there have been already, and there continue to be pressures in which the financial markets are running on the government's ability to support the banking system, very much like you see runs in fixed exchange rate systems. And there are questions about the government's ability to either come up with the cash, given its relationship with Congress, or to come up with or to have the requisite political will to support the banks in a way that speculators would actually lose. So I think my worry is in this current situation is that they've created and they continue to create, and it may be it's a very hard to avoid situation in which speculators can run on the government's authority, if you like, vis-a-vis the banks. And I would emphasize that the more you ease credit in the economy, for example, through the kinds of measures Mr. Bernanke is doing, which I support, one of the unfortunate side effects could well be that you make it easier for people to take short positions in the credits of major banks. So I think that there's potential. What worries me about the bank system is its potential to get worse. And, of course, its potential to spread globally. I think, the discussion is naturally centered around the United States. This is where many of the problems remain and a great deal of the uncertainty is. But I would emphasize or remind you what I alluded to very briefly, but we talk about a lot more on the website, which is the extent to which European governments have a potential fiscal problem because their banks are so big relative to their economies. And we don't yet know the full degree of losses that they have already incurred and may incur through additional financial disruptions, for example, originating in the United States. And presumably none of this is good for emerging market growth, and so that's going to hurt our exports. In terms of the government's plans on the banking system, I have written about this extensively, and I don't want to bore the audience on it, but the very brief summary is that I think some form of government-managed prepackaged bankruptcy is a plausible way forward. It needs to be on the table. The government, I think the administration recognizes it needs a different extension of its legal authority in order to handle the largest holding companies. And I respect that, and I hope that they get that quickly, and I'm supporting it in my conversations with Congress on the subject. I'm fully supporting that. I don't think that's the end of the matter, and I think the lack of... The issue is obviously recapitalization of the banks, and I would rather do that with government money and receive an appropriate amount of common stock, which could then be sold off quickly, but which many people balk at because they feel that's a form of nationalization. I absolutely oppose to government takeover, control, government trying to run the banking system. If the money's not on the table, and I fear that it's not on the table now because of the history of what's happened, then you're looking at some form of debt-to-equity conversion, for example, at the level of the holding company, and there's issues about how you treat derivatives, transactions, obligations in that context. Anyway you look at it, it's a mess. And anyway you look at it, it's a potentially damaging to consumer confidence and business confidence. And, you understand more and more where the Finnish business people were coming from in 91, 92, when they're saying, credit's there now, we could recover, we could invest, but I don't know if the credit's going to be there in 3 months. That's not exactly encouraging you to plow ahead with those projects that you previously thought made sense. And I think it's not just in the United States, that's also globally. So I think that banking ordinarily, I would completely agree with Mike, you could just leave banking alone and get on with trying to stimulate the real economy through other means. But I worry there's a degree of precariousness and instability, and self-fulfilling credit runs are something I would not yet be willing to rule out.
It's important to understand that on the issue of what we're doing about the banks and the financial system, well, to paraphrase Sir Winston Churchill, never have governments done so much about such a problem in so short a time. Right? The actions that have been taken to stabilize the financial system and to restart credit flows have been without precedent in the history of the United States or indeed of the world. right? Federal Reserve has, of course, driven the interest rate to zero. It's nearly tripled now the size of its balance sheet. We had 5 major independent brokerage outfits 15 months ago. 2 of them survive as independent entities. One of the 5 largest banks, Wachovia, has been merged into its previous smaller rival, Wells Fargo. WAMU has been merged, and so forth. Fannie Mae and Freddie Mac have been taken over by the government. $250 billion of government funds have been injected in capital into major and smaller banks, and the list goes on and on and on. I'm not arguing that nothing needs to be done to deal with problems in the financial system. What I think is a mistake is to believe that we cannot get a very substantial recovery unless we fix essentially everything in the financial system. There are a lot of questionable assets that sit on the balance sheets of financial institutions. Many argue, well, their distressed prices are below what they will ultimately be able to produce. And that's the argument for offering more attractive prices for them. My view is, well, if that's really true, leave them where they are. I mean, after all, the banks need to recover. If they've got these assets that are going to be substantially more valuable in a year or two when the economy recovers, then they can sit perfectly comfortably where they are in many instances, if not in all instances. Now, you get a bank that's in such serious trouble that it can no longer meet the official standards for its capital. Then you need to intervene in that bank. And that has indeed happened more rapidly and to larger institutions than has previously been the case in U.S. History. I don't think we should stop that. I mean, if we have the stress test reveal that there are additional institutions that are too weakly capitalized to continue safely in operation, then there's going to need to be not only a capital injection, but some injection of government control to get those institutions back into shape and to limit the risk to which the taxpayer is exposed. But I think the history of past financial crises is you don't need to solve all of those problems at the depth of the recession. An important part of them will solve themselves as the economy recovers.
Final question, Colin.
Thank you. Colin Bradford from Brookings. An important part of sorting out this debate about whether it's a V or an L coming out of this is knowing what the size of the stimulus package is of the major countries. Simon and I talked about this before lunch, but I wanted to raise it here. The storyline coming out of the G20 summit is there was no incremental fiscal stimulus among the G20 countries. That is true. But paragraph 6 of the G20 summit communique states that the concerted expansionary response of the 20 countries by the end of 2010 will be to the size of $5 trillion. That includes automatic stabilizers, that is social expenditures that kick in recessions. That includes the fiscal stimulus that each of them are making, and it includes some of the bailout money that's just been discussed. But it's $5 trillion. It's not mentioned in the media and in the public image or the market communications that have happened in the wake of the summit. My question to you is, does that $5 trillion affect whether it's a V or an L coming out of this recession?
Well, it obviously has an effect, and that's obviously, I think, in both our views. There was no surprise or no news last week, so we didn't revise on that basis. You know, I think that the questions, you know, it speaks to this broader issue, which Mike was also raising, which is, you know, we've done a lot. Governments have done a lot. Policy has changed a lot on many dimensions. But the question is, you know, is it a lot relative to the scale of the problem, right? And I think that's what we were discussing over lunch. To my mind, it's not enough, and to my mind, there's actually a limit to how far you can go with fiscal stimulus because of problems of how much debt you're willing to take on in the U.S. and other industrialized country situations. I think that's why more of the weight falls on monetary policy. That's why I support very radical, what I regard as very radical action on monetary policy, while recognizing, consistent with my overall view, I hope, that if we have a more emerging market type financial political structure, we also probably have more of an emerging market dynamic around inflation. And inflation in emerging markets obviously can go up when you have a big monetary stimulus, even in a situation where the economy is not booming.
Simon, just to nail this down, you say more radical monetary action. Do you mean, I know you mean in Europe, you made that clear. Do you mean also in the U.S.? I thought you said you had supported pretty much.
I'm supporting, and we said in the post on Sunday that we're supporting where Bernanke is now. In fact, we've been pushing them to get to this point.
Exactly.
3 months ago, fine. We are where we are, okay? Given where they are now, I think this is moving in the right direction, and I think they will and should press ahead with it. I think do you
think the Fed should do more now?
I think we're broadly comfortable with what they're doing at this moment, the Fed. The Europeans, not so much.
So the additional radical financial action you're calling for is Europe?
No, on the monetary side.
On the monetary side.
On the financial reform side, I'm worried for the reasons I articulated.
Okay. Mike, get the last word.
Well, I certainly think that one of the reasons why the Reagan recovery was as powerful as it was that not only we have the natural forces of recovery, but the Reagan tax cuts, which were quite substantial, and the defense buildup on the expenditure side provided additional impetus to the recovery. In contrast, the Ford recovery in 75, 76 was not as strong as the Reagan recovery, I think in part because there really was no fiscal stimulus to help boost the recovery from that recession. And perhaps the easing of monetary policy was not quite as dramatic in that episode as it was beginning in July of 1982. So I think stimulus, both monetary and fiscal, helps both to limit the recession and to produce a more vigorous recovery. What I maintain is that for the United States especially, but also for other countries, we are getting an enormous amount of policy stimulus. Certainly on the monetary side in the United States, beyond anything that has previously been done. I mean, the criticism of the Fed in the early 30s was they sat back as the money supply declined by 40% and the banking system was wiped out. That's certainly not our Fed at present. And as I indicated, I mean, they're pumping in huge quantities of reserves, simply flooding the banks with liquidity, in addition to operating directly in key credit markets. So a great deal is being done. Now, you know, the big stimulus package just passed in February. I mean, it was not short-term tax cuts where the checks have already been sent out. So we felt no impact from it yet, and it will be pretty limited in the second quarter. By the third quarter, though, we're going to be getting more bang out of that fiscal stimulus package, and I think that is going to work to boost aggregate demand in the U.S. And the Fed is building more and more the asset side of its balance sheet and the liability side of its balance sheet, and we'll see more effects of that as we move forward. So I'm not just optimistic that the economy will, on its own, recover. I think eventually that would happen. But there's no reason to sit back and just say, well, we're going to let it happen. And that's not what is being done. We're having an enormous amount of fiscal stimulus and an unprecedented degree of monetary intervention to boost the economy. And as I say, I think that will work.
I can't resist closing by saying I thought the Reagan recovery was so robust because Paul Volcker licked inflation. And Volcker agrees. This discussion will continue. I want to thank Mike and Simon for laying it out. Thanks to all of you for coming. To be continued, and we come back in 6 months, and we'll see who was more right or not right at the time. Thanks to both of you very, very much.